And now we're just going to pick up at the same place that we stopped. So when you look at, again, financial conditions have tightened, but obviously not to where the Fed would like, which leads to, again, more support of where they could continue to move rates, as we discussed earlier. But one of the key pieces is the retail side, because when you look at nominal, obviously nominal still is in positive territory. But when you adjust for inflation, there's some expectations of the real sales falling to negative 1.2. And that fits to what we've been saying, or what we believe is that you're going to get a weakness in retail sales that is going to be fairly sizable for the holiday period. And then that's going to continue into Q1 of next year, where we see more slowdowns. And a lot of that is driven based on what we're going to discuss on the savings front. So government transfer payments, share of personal income moved up slightly in October. So again, still right where it is. But when you look at disposable income, back to the conversation earlier, savings rate as of October, now at the lowest since July of 2005. And before that, this is the lowest it's been going back to the 60s. So we continue to see a drawdown of savings, and this is what is keeping people alive. And the problem is, as that whittles down, as it has, mixed with the fact that now we have a record amount of credit card debt on people's balance sheets, rates continue to move up. This is going to become a bigger problem as we go through the remainder of this year. But more importantly, this is how we're going to kick off next year. And 2023 is going to be a very problematic year, and one that I think you're going to see a lot of issues with. And I think this chart does a really good job of showing that, with household excess savings likely gone by mid-2023. And as we've been saying, based on the speed in which it's moving, based on who has the savings and who doesn't, it's very top heavy. So a lot of those people in the lower 80% of the country, they're already gone. It's not going to be gone. It is gone. And that is, I think, the bifurcation that needs to be made when you look at the quartiles, quintiles, depending on how you want to break it down. There is that underlying problem of how much money does this large piece of the U.S. population have? And it's not a whole lot, because the cost of living has gone up so much that accumulated savings is just essentially disappeared for many. Now, there is some of that has been saved at the top 1%, top 15% of Americans. And for some of them, that'll just stay there. It'll go into investments, something else. But where we look at consumption, that's where we already are seeing that pain. U.S. real personal income transfer receipts, you can see just, again, bumping sideways. US PCE inflation, just, again, bringing this back into the fold, because survey was for 0.4, came in at 0.3. So we're just grown. Again, we're right at the same level. We're seeing nothing in terms of a shift in PCE inflation. Core PCE inflation year over year, 5%, expected at 5%. Again, stagflation, just going sideways. You look at month over month, there's really been no big change. The rate of change has slowed, but we're not negative. And unless we see prices meaningfully fall, people are still going to be in underlying pain from a consumption perspective. So the difference between the two price gauges is at its widest in decades. PC price index, excluding food and energy, and CPI, excluding food and energy, have this bifurcation. But the problem is, when you start to look at, it's somewhere where they meet in the middle. And it leads back to how is it calculated, which it's always going to be slightly different in different ways. But there is a lot of staying power in where we are right now. And that is, I think, the biggest problem and the biggest conundrum, is because where we sit in the world is very much in this stagflationary period. CPI construction gives it an upward bias versus PCE. So the construction side is giving some of that additional bump to CPI that PCE just doesn't pick up. Not because one is right or wrong, it's just looking at things differently. So when you blend them together, we still have an inflationary problem, which is not improving while wages continue to weaken, while we see employment starting to worsen, which again is going to hit income and the ability for people to spend. So October construction spending came in at negative 0.3 versus the estimate of negative 0.2. Private construction came in at negative 0.5. Private residential negative 0.3. Private residential home improvement up 2%. Private non-residential minus 0.8. So flatlining. Again, just not seeing much movement up or down. And that's just where the CPI's PCE side continues to see some of those pieces, because you still see a lot of inflation on the construction front, which is propping up that CPI component. Now, the Fed's Beige Book showed a more cloudy outlook for the economy when you look at the Beige Book sentiment indicator, which is that blue and white graph. So again, things aren't improving. It's moving down to where we've seen at a recessionary level. But then consumer expectations minus current conditions, you're seeing a little bit of a bounce. But when you look at it, is it a false bounce? Like, do we get a bounce and then a move lower, as we've seen that predates other recessions? Or do we continue to see this move up? And that continues to see where the expectations are going to continue to worsen versus current conditions, which again is typically showing when there is a recession, which again supporting the fact that something problematic is on the way. All the while, and this again is clouding the employment side, there was a move down in prime age labor force participation rate. It went from down to 62.1 versus the estimate of 62.3. So people still are not participating. So now this is already something that is important, but wage gains, which is blue, is higher, but companies cutting hours is the orange. So you're seeing people work less, and but you're still seeing wage gains right sitting there. But again, it's just a matter of all employees is when you look at hours, all employees. So people are working less. Back to participation, back to how many jobs people can work. And you see this weird conundrum in terms of where things are, which is why as hours continue to dwindle, which speaking back to segment 2, you have manufacturing slowing, you have contraction in all these areas, which means that you're not going to need as many employees, which is going to pull down total employees, which is going to pull down wages, and again, going to increase the pressure on spending. Non-farm payrolls came in at 263 versus the estimate 200. Worth watching, number of individuals unemployed for over 27 weeks continues to tick higher. So this leads back to what we talked about, because this is the establishment versus, the established way versus the household. And we've already gone through how there's a 2 million job divergence between non-farm payrolls and household surveys. And our view is that there's some meat in the middle when you look at all of the regional data, regional Fed data, when you look at ISM, S&P Global in terms of what they're seeing. Some, service jobs are still expanding, not at the same pace, but manufacturing jobs are slowing. So it's a matter of which is being recognized first. Challenger job cuts are going up. So, okay, well, challenger job cuts are going up. Well, is it in the numbers yet? That's more of a leading indicator. So you're starting to kind of get this picture how each data set is showing a point in time, but all of them are showing weakness, just not exponential weakness. And then as the labor force continues to not participate, that's going to artificially, or at least keep the unemployment rate low at 3.7, 3.8%, going to continue to push the Fed to tighten. So this is the November average hourly earnings came in at 0.6% month over month versus the estimate of 0.3. Now, this is the strongest gain since January. And when you look at hourly earnings, is this the start, or is this supporting a price spike, a wage spiral? And this is going to support, again, prices paid going up and prices received, staying elevated in that stagflationary backdrop. But I think it's way too early to still say that this is going to be a wage spiral, but that is going to keep the Fed look at this, guys. We're still have more work to do, because clearly there still remains a lot of that slack in the market. Richmond Fed index ticked up to -9 versus the estimate of -8. New orders, lead times, and business conditions all ticked higher, but still stayed in contraction. Wages moved lower, prices paid eased, but employment fell into contraction for first time since July of 2020. So again, all moving down. Global U.S. manufacturing, it was expected at 50, came in at 47.6. New orders came in at 45, all of which are deeply in recession. When you look at U.S. services PMI, survey was for 48, actual came in at 46.1. Incoming new business came in at 46.7, all of that steeply negative. When we look at manufacturing PMI input prices, 62.2, but still above 50. So it's still increasing in price, just at a slower rate. So then the regional new orders composite survey versus ISM national new orders, all of which point to a contraction, which again is going to be a problem for the underlying economy. October wholesale inventories came in at plus 0.8% month on month versus the estimate of 0.5. Retail inventories fell negative 0.2 versus the estimate of negative 0.5. So still fairly comfortable on the inventory front, which is, again, going to keep that pressure on the manufacturing piece as we've been highlighting. U.S. real personal consumption expenditures were expected to be at 0.5, came in at 0.5. Consumption remains a positive contributor to U.S. growth, and we were expecting this to roll over or start to roll over in October. Instead, it stayed firm. So, by default, we're going to say that November is going to be that piece because all of the data shows us that it's happening. The question is going to be, when does it really show up? Like, did people go out and spend in October because there were a ton of deals and sales, and November is really going to be the piece? But all of this is leading to the same conclusion that problems are alive and well. Holiday spending grows despite inflation woes, which is a net positive when you, again, coming back to where we were on Thanksgiving Day, Black Friday, Cyber Monday. Online shoppers are okay. Black Friday sales stayed above $9 billion, but we did see a lot of additional sales in order to do that. So even though they were better, how much margin was eaten into, and was this enough of a pop in November to keep things growing at a steady rate, which then means December would be fairly ugly. Credit managers index moving down, so you can see again moving into contraction. But when you look at the capital crunch and the losses surge this year at the biggest U.S. banks, that's when you look at the credit managers and the concern they have, because there's a lot of losses, and a lot of this is based on asset adjustments for mortgages written for assets that were put as collateral, which they have to leave as bad debt expense until they can make some sort of margin calls, which is, again, going to weigh on the amount of capital that banks have available to push into the market, which is going to be a problem for companies trying to borrow, putting pressure on their CapEx, limiting their investments, limiting their ability to continue to invest in hiring individuals. And then the banks, looking at differently, the mortgage misery, if as you will, it's now more profitable to buy a 6-month U.S. Treasury than to buy real estate. They're earning a lower yield than different levels. So when you look at the 6-month Treasury going up, the cat rate coming down, mortgage bond losses have swelled in available for sale portfolios, which again is a bigger problem when you look at banks and in terms of the bad debt that they have to keep on the sheets. Now, when you start looking at how this leads into pending homes, because remember, home pricing is going to be a big piece of how people feel wealthy or their ability to spend. So pending home sales now down by nearly 37% year on year, which is the worst annual decline on record going back to 2002. Pending home sales firmly in recession, down negative 4.6% month on month versus the estimate of 5.3%. So again, better than the estimates. Fifth straight monthly decline in sales and level, now hovering near pandemic lows. West was worse. Midwest was best at positive 3.3% gain. So again, it's a back and forth as to where things are, how are things sitting, what does it look like, and we just continue to see a lot of this back and forth. But in long and short of it, the data is getting worse for the housing side. So then when we look at CoreLogic May 2022 analysis, the odds of regional home prices dropping over the coming year, the view was very low. And again, for anybody who has listened to me, I have said that was wrong. I was like, how home prices are going to implode. And now CoreLogic's November 2022 analysis, the odds of regional home prices dropping over the coming year is very high. Shocker, I know. So now when we start looking at CoreLogic Case-Shiller composite, you can see that the expectation was for minus 1.2%. Actual came in at minus 1.24%. 3-month change in home prices, you can see the big reversal down. But even with this reversal, the purchase-only house price just slightly ticked down versus the average hourly earnings of production non-supervisory employees. So earnings have ticked up. Home prices just started to tick down, but look at that gap. So you're either going to send income surging, which is, again, a wage spiral, or you're going to see the house price index collapse. And typically I like to say there's going to be a meet in the middle. I think there's going to have to be a big price index collapse in order to make anything move on the real estate side once again. And then when you look at assets at the balance sheet level for the Fed, the mortgage-backed securities are still sitting on the balance sheet because because of all of these losses, because of all of these issues, you're not seeing the Fed able to sell this into the market without creating more pressure, which is why they've held off, even though they've started to increase more aggressively on the U.S. securities front. Average days per week working from home after the pandemic has continued to move up. Percentage of paid full days working from home are remaining stable, which again, work from home, flexible schedules. Spending patterns are going to change. Consumption patterns are going to change. And that is going to be something that is going to be fairly permanent, not at peak COVID levels, but fairly stable as we go through how we consider working and what that work looks like. New home sales push forward 8 months. Houses under construction still remain, again, that huge gap between the two, which will start to come down. Now, the fun thing is on the Fannie and Freddie, the maximum size of a single unit mortgage eligible for backing by Fannie and Freddie is now over $1 million. Baseline limits, high cost limits. And the problem is you keep seeing it move up, which means that the government is supporting more and more of these prices, which is wrong because it's at the wrong level. And the last time they did this, and then there was a big correction, was 2008, 2007, 2008. So they're leading themselves right down the same path, which is a disaster when you think that we should have learned from our mistakes the first time. So then when you look at the U.S. commercial bank interest rates on credit card plans continue to surge. Again, more pressure to the consumer. Diffusion index of every possible yield curve inversion is surging, which is all a prerequisite for a recession. U.S. leading indicator contracting, ISM moderating fast, again, showing you that pull down, that slowdown, which leads to showing you the consumer slowing, manufacturing slowing, all of these components getting worse. Then when you look at the Philly Fed, more cuts to work week coming, 6-month forecast for hours worked within November's Philly Fed index fell to the lowest since December of 2008, which pressure on wages, pressure on spending, all of those things continue to whittle throughout. Richmond Fed Manufacturing Index was expected to be at -8, came in at -9. New orders, again, all coming down. Look at Richmond Fed manufacturing wages, still elevated, which again has to be covered as a cost. But as it continues to moderate, as inflation remains elevated, again, that becomes more of a pressure on underlying spending. Number of employees came down to -1, back into contraction. Raw material inventory surged, which again shows a slowdown in demand, but also that normalization on supply chains. Prices paid has come down, but still remains elevated. But prices received have now surged. So again, this chart shows you stagflation where, yeah, it's still increasing, slower rate of change, but a lot of stagnation in that. All of this leading to all culminating into the delinquencies. When you look at delinquencies in general, auto loans by age, auto loans are typically, for some reason, the first thing that starts to go delinquent, and you can see that it has aggressively started to move higher. Transition into serious delinquency by loan type. Credit cards are moving up. Student loans, obviously with all the things that are being said out there, those are going to stay fairly flat. But credit cards and auto loans are the key ones to watch. And if you look, in 2008, you saw a very similar move, and that's where we get more concerned when you look at the pressure on the underlying consumer. Pending home sales slid for the 5th consecutive month in October. Pending sales fell 4.6% from September and 37% from year on year. Pending home sales are forward-looking indicator of home sales based on contract signing. So again, more pressure. Resale market cooling fast. A number of consecutive monthly declines in home resales. You can see that this is the worst ever, going back to 1968. So again, a lot of problems there. Housing freeze hints at rapid transmission of monetary tightening. So home resales dropping, but based on everything that we've seen, they need these prices coming down given that big disconnect. So then when we look at supply available on the market, U.S. home buyer must now earn $107,000, $281 to afford a typical $2,682 monthly mortgage payment, which is up 45.6% from $73,668 as previously. So again, it's just the cost of owning is so ludicrous that is going to keep people on the sidelines. Share builders adjusting prices during the month. The continues to shift when you look at a lot of those adjustments with MBA purchase index, which is the worst going back to 2013. Building permits remaining fairly elevated, but again, MBA purchases coming down. New home builder sentiment, more downside risk is there. S&P Core Logic, again, even though we've seen it come down as we showed earlier, it's still up year on year at 10.65%. So again, even with a normalizing month on month, there's still way more downside to go. Now, rounding it out, existing home sales continue to tank, as we showed earlier, with another record spread deeply negative between the number of homes in the U.S. completed versus under construction. So even as all of these home sales continue to tank, there is a ton of new capacity coming to the market, leading to more oversupply and going to pull down pricing even further. So that's what we have for you in the U.S. In the next segment, we're going to go into what is happening on the European front.